it's noon, so we're going to go ahead and get started with just a few housekeeping items while people are still joining. But we just wanted to start off by saying thank you so much for your time today and coming out. This is a business builder webinar, and today's topic is the top 10 tax strategies every business owner must know to save money. So, just a few housekeeping items. If you have any questions, we're going to keep everybody muted. Pop them into the Q&A, pop them into the chat, and if we can, we'll stop and take a few. If not, we'll wait till the end of the presentation and answer those questions. We'll also have some polls through this as well. So definitely want to participate in those. And then at the very end, you're going to want to hang on because we have a very special offer for you. And Phillip will walk you through that towards the end. So let me go ahead and introduce our host. We have Phillip Long. He is a technologist and entrepreneur, and he specializes in providing technology solutions in security consulting to businesses along the Gulf Coast. So he's been in the IT industry for over 20 years. He also has 600 plus clients from Gulfport to Dothan, and he is the current owner of 5 businesses. He also has his Certified Information System Security Professional accreditation, that's a CISSP, and his CMMC designation as well. So now I'm going to introduce you to our very special guest. We have Michael White. He is a CPA manager at Byers, and Associates. So he specializes in multi-state business taxation and compliance, international taxation, and consolidated tax reporting of multiple entities. He also has experience in both the public and corporate accounting sectors. He is a member of the American Institute of Certified Public Accountants and the Alabama Society of Certified Public Accountants. He's an active member of Christ the King Catholic Church in Daphne and serves on both the finance and parish councils. He volunteers with several nonprofit agencies giving back to the community he lives and works in, and enjoys spending time cooking, hunting, and fishing, and following University of Alabama football, as he says, Roll Tide. So I'm going to go ahead and I'm going to pass this off to Phillip.
Roll Tide. All right. Well, thank you, everybody, for joining us. And thanks, Michael and Christy, for her work in putting all this together, and the rest of my team. We're going to really jump right into it. But I want to kind of just give a little bit of a prelude of why I do these things. And this really is more about just trying to help our business community, because a lot of times we get ourselves into a position where it's kind of lonely at the top. You don't go talk to your people about how you're managing your finances, or so I like to bring people on like Michael who can help us ultimately get the most or keep the most of our money. And that turns on every business owner in the world. And what I've learned over 21 years in business, and I wish I would have learned it a lot earlier, but it's a matter of really keeping even small percentages over long periods of time make out for a lot of money. And so if you get a good accountant, you get a good understanding, you get some guys, and you're passing information about how to make the most out of your money, and keep it away from the government, keep it back in your pocket, I think it'll make for a big play at the end. So I want to introduce Michael. Michael, got any words to get us started?
Thank you for having me. And would just like to say, preface it, that what we're going to discuss today is of a general topic nature, and it's not meant to be tax advice for a particular situation. So I recommend that you take the information that we're going to present and discuss it with your professional advisors and or do additional research as your particular situation might require.
Spoken like a professional CPA right there, bro. I love it. So
well, unfortunately, the tax code and everything is based upon, primarily, when you get right down to it, individual facts and circumstances
for sure.
That apply. So we can't just give a broad-based, one size fits all, answer,
Got it. But let's talk a little bit just about choice of entity and, why that's important. You'll kick us off with that topic.
Okay. Well, there are several types of entities you could operate under. You could be a sole proprietorship. You could be a general partnership if you have two or more people wanting to come together to try to be in business together. You could have a limited liability company. That's an LLC. Many people think that C stands for corporation, but it doesn't. It stands for company. And you could have a C corporation. So those are the types of entities you could have. And somebody might say, well, hey, wait a minute, what about the S corporation? And the S corporation is not an entity choice. It is a tax choice that you elect to be taxed as an S corporation. But first and foremost, you have to be either a C corporation or an LLC taxed as a corporation, elected to be treated as a corporation in order to elect S corporation status. With all of them, you got various aspects of all of them. Primarily, if you were wanting to have just open up a business, and go into business for yourself, sole proprietorship is the easiest one to get started because there's no filing requirements. There's no separate income tax filing. You're going to report all the income and expenses of your business with your own personal tax return. However, it doesn't offer you any liability protection. So, if you get into trouble, then you might be exposing your personal assets to liability. And also, there's no federal identification number requirement unless you have payroll, and then you got to have one. But I will say this, that I've experienced some instances where some like a bank or something still requires you to have a federal identification number. So you may end up having it even though you're not required to.
Yes.
And then you have go ahead.
No,
then you have a general partnership. Again, it's easy to get into. You just have to have a basic agreement between you and the other people that you're going to be in partnership with. But you don't have liability protection. Basically, everyone's still liable unless you were to be a limited partner in the agreement. And more importantly, though, from an income tax standpoint, it's a flow-through entity, meaning that the partnership itself pays no income taxes. All the income and expenses flow through to the partners proportionally according to their agreement, and you pay tax at your own personal tax return. Yeah, gotcha. But you would have to have a federal identification number for having a partnership to file a partnership tax return.
Yeah, this is something definitely that you'd want to go into and meet with somebody and go over your specific situation, pros and cons, and even I would say, like the business owners out there, and then look at how you're doing. I've just built a wedding venue, and we're going to get our liquor license. And so we're going to actually, I want that way down the road from being able to touch me personally. So the entertainment company will be doing the liquor license. It'll have insurance, and then it'll flow back to the entity that owns the actual venue, and then it'll flow back to the property, L&W property, a property entity, and then I'm like fourth in line. So, I mean, that's really where these things start to pay off, right? Is to separate you from risk.
That's true. Some other type of entity that puts you between the liability claim itself and the ultimate outcome of the claim, so that you're protecting your personal assets that you built up over the years that you don't want anybody to come in and garnish or take or whatever because something went wrong in your venture.
Yeah, and it's really relatively inexpensive nowadays to start up one of these entities for the most part. I know a C Corp can get a little, if you got a lot of assets and you're, there's some benefits, and I don't know if you were going to talk specifically to C Corps or not.
Briefly, I was going to say C Corps are probably the most weighted for having to have filing requirements and also having legal documents, because, you got to have, issuance of stock, and you need to have minutes of the board of directors meeting and certain documents that need to be in place. It's real important from a tax standpoint that you do that because you want to have everyone on notice that you're actually operating as a separate entity, and don't think of the entity and you being one and the same, because you're really not. And as far as liability protection, there's a term that is passed around called piercing the corporate veil. And if, in a litigation sense, that you can make the connection between your personal activity and the corporate activity, you're not keeping them separate, then they may decide that the corporation is really not separate from you and come and try to attack your personal assets anyway. C corporations do pay a separate income tax. So we do have double taxation in the sense that corporations are going to pay tax on the money, and then if they want to distribute the money to the owners in terms of dividends, you're going to pay tax again. So there is corporate double taxation from a C corporation.
Yeah.
But it offers some benefits that other entities don't offer, and we'll discuss those in a little bit in one of the other topics. Finally, like I said, S corporations are not an entity choice. It's just a tax treatment under the Internal Revenue Code, and most states follow the same. There are a couple of states I think that don't allow S corporations, but most of them do. And it's just a matter of you having a C corporation or an LLC taxed as a C corporation that you want to have the flow through all to the owners for the income and expenses. So you might want to elect S corporation status at that point.
Gotcha. Like of all my business buddies and everything, I only know one of them that is a C corp, and he is very sophisticated in what he does. And I would say that would be, like, for a small business, that'd be probably the most complex one, you would say.
I would think so. It would be you would have to have a real need for having a C corporation. It could be that you've got way too many shareholders, because S corporations are limited in terms of their shareholders, and they also can be limited in the terms of the types of shareholders. So you may have to go the C corporation route. So probably, though, the most common today is the limited liability company.
Mm-hmm.
It seems like it's offering you the liability protection for the most part, and it's fairly straightforward and easy to get into. Some people decide that they want to file their own organization papers, and in some states, you're sure you can do that. But I don't often advocate that because you want to have some things in place in writing in the organization agreement and the operating agreement.
Yes.
And it usually ends up well worth it to go to an attorney and have those documents drawn up properly and know that they comply with the law.
Yeah. I want to talk a little bit about operating agreements too. That's something that I think how many businesses you deal with that actually have a viable operating agreement? Not many, or what do you think?
I've not seen many. I've seen some basic ones, but if you see an operating agreement, usually they've taken the step to go to an attorney and get one drawn up.
Yeah, for sure.
That says, and it addresses things such as how we're going to split the profits and losses, how you're going to have the ownership and things like that, that you want to have in writing up front, so everybody understands, as the business starts to operate, that this is what's going to happen.
Yeah. Of anything that I've seen where people really have gotten into trouble on things is not having that functional operating agreement and setting up 50-50 partnerships and things of that nature. Those can get really, because there's no real means for resolution.
That's true. And then you have to rely upon the court system, to make a determination. And sometimes the outcome is not what you want, so,
sure.
If you discuss it up front and everybody has a clear understanding up front going into it, then usually you have less difficulty, at the end of it. And also you need to address, how are you going to get out of it? If somebody is unhappy, if a member is unhappy, how do they get out of it?
Yep. That document right there from a partnership perspective is probably, everybody thinks that, it's like young people getting married, they think it's going to be peaches and cream. And the reality is that this world is pretty tough.
That's for sure.
So let's move on to this next topic about really just choosing the method of accounting and accounting periods. I know that that's a very important thing. I'll give my one example. What I believe would be relative to this topic is we got rolling, and about our second or third year, man, we were crushing it, and we weren't paying quarterly taxes. And it come tax time, and boy, I thought I made some money, and I had to write the IRS like $100 and something $1,000 check. You talk about painful. I had to scrape up my piggy bank to get all that money together.
Well, that can happen certainly if you're not going periodically, at least touching base with your professional tax advisor and saying, hey, I made a bunch of money already. Can we take a look at this and see what we need to do? Because you don't want that surprise at the end when you get the piece of paper known as your tax return to file it. You want to be more proactive and make a discussion with your tax advisor. I found quite often that sometimes the tax advisor is the last one to know, and they probably should be the first one to know, not the last one to know.
I'm an advocate of quarterly meetings with your tax people because, I see you could have made a decision. We're going to talk about Section 179 later. And, really, people come to me, they met with their tax guy on the 20th of December, and they're like, yeah, I need to spend some money. I want to upgrade this. But by law, it really needs to be plugged in and working. And there's just no way I can actually achieve what's required because there's not enough time. I think quarters are good means. Months too often for most businesses, quarters are about the right rhythm. And I really advocate that because it'll keep you from, getting your feelings hurt or thinking you're making money when you're really not. And, you can make an adjustment quicker than waiting on an annual basis. That's
true. The more proactive you are in that regard, quarterly or at least semi-annually, the better off, the result will be at the end of the year. You get time to plan, like you said, that 179 deduction and also the bonus depreciation deduction hinges on the property being in service. And, if you can't put it in service, then you probably can't use the benefit of the tax write-off. If you wait to the last minute at the end of the year.
We've had to do some crazy things to accommodate clients in that situation. So for sure.
But anyway, as far as method of accounting and accounting period, let's take a look at the accounting period first, because basically there's two types of accounting periods. Fiscal years, which means any 12-month period other than a calendar year. Now, there's some limitations on what kind of entities can use those. Primarily, C Corps and LLCs, taxes as corporations, can use a fiscal year. Other entities can use fiscal year, but you got to jump through some hoops to get there. Sometimes it means that you got to, prepay or at least put up a tax estimate in order to get the benefit of a fiscal year. All other entities, LLCs, taxes, partnerships, certainly sole proprietorships, all you have to have a calendar year because you have to have the same year as the owner of those entities. So those are calendar year basis. But why is it important to choose whether you have a fiscal year or a calendar year? And you kind of have to, before you make the decision, you have to look at your business cycle. And pretty much you want to determine when your sales and inventory are at the lowest point, because you don't want a bunch of inventory sitting on the shelf and not being expensed out, and sold. So like if you had a retailer that was buying a bunch of Christmas items to sell, they want to be down to their lowest amount of inventory by the time the end of their year comes. So that's probably one of the most important, if not the most important reason why you want to make a fiscal year or a calendar year. And like I said, if you say, well, I really need to be on a fiscal year, then you've got to pretty much elect to be a C corporation or an LLC taxed as a C corporation. Otherwise, you're just, for tax purposes, you're stuck with a calendar year.
Gotcha.
The accounting methods, there's two basic accounting methods that you have. One is called cash basis. And cash basis basically means that all your revenue is taxed when you receive the cash, and all your expenses are deducted when you actually pay them. So you want to think cash in and cash out, and that pretty much determines the taxability reporting of a transaction. It offers you the most flexibility to defer your income or accelerate your expenses. But some entities can't use them. C corps and partnerships with C corporation partners can't use them, except back in the last major tax law change we had, they implemented what's called a gross receipts test. And if your gross receipts for the prior 3 years are 26 million or less, then perhaps you can still use the cash method of accounting. The second method is accrual basis of accounting. And accrual basis of accounting basically says your revenue is taxed when you earn it. And there's a test that you pretty much apply to determine when you earn it. And it happens when all the events have occurred to establish your right to receive the income, and you can determine what the amount of the income is with reasonable accuracy.
Let me ask you, just in layman's terms on that accrual basis, what entity, I mean, give me a scenario where that would make sense to do that.
To do the accrual basis?
Yes, sir. Yes.
If you want to, if your expenses, your payables were outpacing your receivables, in other words, you were having to have major outlays, but you're not going to collect the money till sometime down the road, that may be an indication that you want to consider at least the accrual basis, because you want to be able to deduct those expenses that are outpacing your income. And
gotcha.
if you're on cash basis, certainly you can deduct the expenses, but you're not going to get the income till you actually receive it. And so, you just have to kind of look at it and see from a transactional standpoint, which would be the
and
best
you can't
way to go.
Flip back and forth.
No, not easily. Anytime you want to make a change in accounting method, you have to apply. There's some changes in accounting method that are automatic by the IRS, but others you have to apply, send in an application, and then they have to approve the change in accounting method. So,
gotcha.
You certainly, and anyway, you wouldn't want to flip back and forth. I don't think because it wouldn't make sense.
Screw your books up. Yeah, you wouldn't. Yeah, it'd mess your books up. I can see that.
Now, I will say this. Some people, they operate on an accrual basis for their financial records and everything, but they still go cash basis for the tax return. However, that adds a complexity to it, because you have to make the transition from accrual basis to cash basis, and it involves some extra work and everything that may involve extra expense. So, you got to weigh the expenses versus the benefits
gotcha.
by doing that.
Gotcha.
And you got to consider, and they also have a rule called the applicable financial statement. So if you had a need to issue financial statements to outside third parties, say you had a line of credit, or you needed a loan, or you needed a requirement to issue a financial statement, then you might have to prepare your financial statements on an accrual basis. And so the law says that you would recognize your income at the same time you recognized it in your financial statements. Gotcha. If you were publishing financial statements to an outside third party.
All right, gotta keep it moving here. Let's talk about this big 865,000 new IRS agents or something like that. Every business owner heard that, I'm telling you, pissed.
I know.
It's like you think they're going to be up in your Kool-Aid. What's your take on that? Is it an overreach, or is it neat? I know that, we were just talking about some stuff and they're way behind, and, indeed they are behind. The IRS is behind, but what's your take on all that?
Well, I don't think it means what's been in the news and everything. It doesn't mean that you're going to have 87,000 new gun-toting IRS agents knocking on the doors. And the reason being is because the IRS is in the same boat for getting qualified people that every business owner is in, finding enough people to staff up. And you're just having difficulty these days finding people, qualified people to fill the positions. IRS is going to be in the same boat. They're going to have to go out and try to find people and train them and everything. And that's going to take quite a bit of time. But even if that, they need tech support specialists, and they also need customer service representatives. Those people are not going to be auditors, but they got to have it. I mean, to straighten out the mess that they're in, they got to have people to be able to do it. And finally, there's attrition. You probably got some estimated some 52,000 aging employees at the IRS that are near retirement, and they're either going to retire or resign. So. Yeah, all that's got to be filled. So it's going to be somewhat a balancing act. And I just don't think that you're going to have a bunch of people just clamoring out there to join the IRS ranks so that they can immediately staff up. So it's going to take some time.
Gotcha.
But, on the downside, if you hire a bunch of new people and you train them and everything, and they don't have any experience in the field of going out and auditing tax returns and everything, what do you normally do when you don't have experience? You rely on your training, and you pretty much go by the book. So it might be a little bit more difficult with some of the newer staff, to go through an audit than some of the more seasoned staff that are out there conducting the audits.
Yeah.
Today.
Yeah, somebody may have that's where, I think, I've heard that, we think of the IRS, we think of it as black or white, but really there's an enormous amount of gray out in that world. And, I could see where, a young buck coming in could, be making mountains out of molehills and jamming up the wheels of the system even.
Well, I mean, to give credit to it, they've got the training, they've got everything, but the training doesn't necessarily always address everything that Congress intended about the law, and that's where the gray area comes in. And so a lot of it's up to interpretation. I mean, the laws are made, and then the courts make a determination and set precedent. So all that's not necessarily black and white in the training. So then that's where additional discussions and trying to compromise comes in, under an audit, to say, well, we believe it's this, and so you reach a compromise.
Gotcha.
And you may have to give up on some issues, but you get the benefit of other issues.
Gotcha. Here's one that I think a lot of business owners, I would think nowadays, know about this. Maybe they are, maybe they're not taking advantage of it. But what's the benefits? What's the pitfalls and all that kind of stuff in hiring your children?
Well, I'm sure you've seen on TV, or most of you probably seen on TV the ads where their kids are advertising for the companies, and that seems to be a perfect example of use of the IRS rules, to hire your children. Your children can work tax-free for you if they stay within certain thresholds, and currently that's $12,950 a year that you could pay one of your children a year, and it's going to go up next year up to, I believe, $13,850. If they're under the age of 18, you don't even have to pay Social Security or Medicare tax. And, if they're under the age of 21, you don't pay any federal employment tax on them. So it can provide a good benefit to the business owner to, shift some income to their children. But I will say this, you do have to watch out for state filing requirements, because not all states follow the same rules as the IRS does. So even though you may get out of, filing requirements and or paying federal income tax, you may still have to file a state tax return for your child and pay some state income tax.
Gotcha. Yeah. But, I never thought about just the overall, even in advertisement, that would be an easy mark, and a lot easier mark than what I've been doing. I've been making my girls work. So they'd be a little happier. But so that's
Yeah.
something always, again, that's tax-free money. And it goes down to what I think and what I fundamentally believe is that, it's not the home run balls that get us there. It's the base hits on a consistent basis over a long period of time. I always say, yeah, just stay at something, work your ass off. All you have to do is work 6 half days. That's 72 hours a week. And you do that for 20 years, you'll be an overnight success.
That's right. That's right. I will say this about this hiring your children thing. It doesn't work real well for incorporated businesses.
Really?
But perhaps you can do a workaround. Basically, you form an unincorporated business to manage all the activities. In other words, you manage the bookkeeping, the scheduling, everything when it comes to hiring your children, and then you charge your corporation a fee for doing that, and then you actually pay the children out of this unincorporated business that you form, to do this. So you just have to be careful that the IRS can't come in and make that the reason why you do this is basically for tax purposes only. It has to be some legitimate business reasons for doing it and establishing those reasons. And if you do, then perhaps that would be a way of doing it, because those limits that I mentioned previously, those are basically for unincorporated businesses. So that would be a way around it for the corporation.
Gotcha.
But when you hire your children, you got to do a couple of things. It's got to be real employed. They got to be real employees, and it has to be real work. And you can't pay a child to stand outside and count the cars going by. It's got to be real work and be associated with your business. And and it's got to be reasonable compensation.
Yeah.
You couldn't pay your child X amount of dollars for just taking out the trash. If it was excessive. But going back to the advertising thing, you could pay them the market rate for advertising, for having people doing the advertising, and that may be a way of doing it.
Yeah.
But it's certainly important to comply with all legal requirements. I mean, get
That's
W-4s and I-9s, and make sure you look at the labor laws for the state in which you're operating in, and make sure you're complying with the state labor laws. And there are some federal labor laws that you got to comply with.
Gotcha. What is the SALT deduction? I tell you, I've never heard that, and I thought I knew a little something about all that. Am I missing a deduction, Mike? That's what the hell I want to know.
SALT deduction. When you think of SALT deduction, we're not talking about scraping up the spill salt off the dinner table here. We're talking about a tax benefit. And back in 2017, the federal government in there came in and they said, as far as your state and local income taxes, we're going to limit your itemized deduction to a maximum of $10,000 per year. So, all the states, in particular the states that have high income taxes, were screaming about it and saying, this is really not a fair way of, because all our citizens in our states are paying all this income tax, but they're not going to get the benefit of the deduction. So they were looking for ways to get around the situation and went through several types of situations where they tried, and the IRS came back and said no. Most of it was related to some sort of contribution would be made to the state, and then you would get the benefit back from it, but it would be in the form of the income tax you're paying. And the IRS said no, if you derived a direct benefit, you weren't going to get the benefit of it, and you couldn't deduct it anyway. So then, a couple of states, put their heads together and they decided that perhaps you could pay this state income tax at the entity level. That became a really popular idea. For S corporations and partnerships, including an LLC that would be taxed as a partnership, or an LLC that would be elected to be taxed as an S corporation. What it boils down to is you go through the calculations and everything, but you have to look at your individual tax returns first and say, number one, is my state and local income taxes being limited? And number two, am I even itemizing? Because the only way you get any benefit is if you're Either you're limited or you're not itemizing on your personal tax return. And we have today about 22 states that have passed laws to make it possible to pay their state income taxes at the entity level. But you can imagine with 22 states, you can imagine that there's enough difference in the tax laws that for this discussion, you're going to have to address it with your own state and your own professional advisors in your state to know what the loophole, what the things you got to jump through, the hoops you got to jump through to get there, because some states make you register, some states, make you, put additional forms in your tax return. So you just got to take a look at it and see. But at least until when the SALT deduction expires for the federal government, which is the end of 2025, at least for the next couple of years, you might get a tax benefit out of this by paying the tax at the entity level.
But it's an estimated tax, and if you put the money in, it's funny because now you just described what I just did in a LLC with a group of guys. We actually just did this. I had to go deposit money, and we didn't know. One person said it had to be paid by December 15th, and the other one said no, you had all the way till the 31st. So we went in and paid ours on the 15th to be sure we were paid. But so I actually have done that, but it wasn't explained to me with that term. But one of the things that my understanding with what we did is that you pay an estimated tax, and you can't really, it stays on the books, right? They won't write you a check back if you overpay.
I think at least in Alabama, there would be some possibility of refund if you overpay it.
Okay, cool.
So, sometimes states say, well, we're not going to make refunds back to the individual shareholders / partners. We're going to make a refund back to the entity itself. But other states say, no, the taxes are really flow through, so we're going to make a refund back to the individuals. So you just have to look at it from state to state, because it's all different.
That's something everybody needs to put on their little notepad to talk to their accountant about for sure. Because I knew what the savings was by doing it, and it was substantial, and it was worth doing. So. Well, cool. Let's talk about moving from tenant to landlord.
The reasons why you might want to move from tenant to landlord is if you're either in a building or you find a building that you could think that may increase in value over the years, you may want to be a landlord and not just pay rent out, because you never would participate in the increased value of the property. I mean, the other reason you might want to be in a landlord is if you buy the building and there's excess space, you might benefit from renting out the excess space to other tenants. So it's a means of amassing wealth, by being a property owner.
That's right. And at the end of the day, you could even, like if you sold the business or whatever, you could still remain the landlord.
That's true. If you keep it separate, and most times we advocate, not putting the property inside the entity itself. You would own the property individually, and you would perhaps rent the property to your own corporation. Now, you do have to be careful with that because, rental activities by their very nature are deemed to be passive for the most part. So if you're renting your property to your own entity, you could generate passive income, but the IRS says that passive income is really not passive because you're related parties. So you may have this income, but maybe not be able to offset other passive losses that you may have from other activities. So just you have to be real careful. You can aggregate the two activities together and treat them as one, and go through that process that may allow you to treat the income as passive rather than the default passive income, non-passive income, because you're simply renting to your own entity. So
my understanding, what is passive income taxed at a higher rate than
it's not taxed at an higher rate, but if you have passive losses, they can be limited and suspended. and you may have to carry them forward to future years when you generate passive income to be able to offset them.
Gotcha.
So that's the passive rules in the brief nutshell. I mean, the passive activity rules have been around since I think 1984, or somewhere thereabouts, and Congress didn't want to give a benefit to all these partnerships that were popping up and having these huge losses, and some of them not having any economic reality to the loss. It was just mostly the tax losses that people were getting.
They were figuring ways to lose money. Yeah.
Right. So, but if done right, it works real well. To be your own owner and to have your entity, renting the property from you, and then ultimately, when you got ready to retire or you got ready to sell the business, the rental property itself, hopefully it's appreciated enough in value to have some wealth accumulation that you can enjoy.
Yeah, I've done that pretty much forever, and there's actually some in the banking industry. I don't know if it's still there now, but there was actually, for people who did that, there was special rates and longer terms for people if you rented out, if you occupied 50% of your space or whatever. So that's something to think about, talking to a banker about if you do that. Let's keep moving here. Let's talk about maximizing retirement tax deferral. That's another one of those things that, over time, one of those things that I think of, like, over time, a little bit of money makes for a big return.
That's true. I mean, you want to try to have a retirement plan in place as early as possible and as early in your career as possible, so that the amassing of wealth and the increase in the value of the accounts over time will appreciate significantly enough to provide you with a retirement nest egg at when you get ready to retire and enjoy life, that you got something to fall back on and live on at that point. So it's very important that you try to, if you're just employed, that you maximize your deduction, your contributions every year, and try to put away as much money as possible. I will say that this area, obviously, we could have one whole day probably just on this one topic alone, because there's so many types of plans out there. But there are two that maybe not too many people know about. One is called a pooled employer 401k plan. And this came about as a result of the Secure Act in 2019. And basically what that does, it allows a bunch of individual businesses that don't even have to be related to each other to go into a multiple employer type 401k plan that's managed by a outside plan provider, and share the cost, the administrative cost. And, they don't have to be related to each other. And basically it's usually this type of plan would be good for small to mid-sized businesses that either don't have a plan in place, or they're not interested in the fiduciary responsibility, and everything else that goes along with having your own individual plan. The employer is no longer the plan sponsor. The pool plan provider is the plan sponsor, and they're responsible for making sure that you're not too top heavy. You comply with all the ERISA laws, and you file all the administrative paperwork, and et cetera. So it may be a means for you to get into a type of plan if you were operating a small business.
Let me ask you that, like who like the plan administrator, a lot of times, they'll manage money. Once you get, bigger dollars, they'll manage it at lower fees. That could be a benefit of something like this too, right?
Possibly, but sometimes the money manager type person that you have involved in it, they're just managing the investments, and they're not doing the behind the scenes administrative activity. Sometimes that would be another entity out there, another company out there that would do the behind the scenes requirements. And in this case, that would be a plan provider. Now, it may be that the plan provider in this instance may do both sides of it, manage the investments and also manage the administrative side of it. You just have to, discuss it with your, professional advisors and try to find one out there, a company out there that's actually doing this. And I mean, it's fairly new. I mean, in 2019, you think about it, we didn't have instances too much prior to that. Because, obviously everybody knows what's going on since 2019. We had all the COVID stuff and everything else. And it probably, this is still fairly new, even though it got enacted in 2019.
Gotcha. What's
the other?
Was there a second one? Yeah.
Yeah, we had another one out there that not too many people know about. I think perhaps you know about it for sure. The cash balance pension plan, on top of a 401k plan. And this works or can work really good for high income business owners because it allows you to put away a lot more money than you normally would be able to put away in a 401k plan by itself. But you got to, a cash balance pension plan is pretty much akin to the old defined benefit plans, and they can be costly in terms of administrative costs. You got to have some actuarial calculations, so you need to bring an actuary in on the situation, and so it's going to have some cost involved in it, but the payoff becomes because you're putting away a whole lot more money in tax deferring it, to down the road when you decide to retire, and it may provide you a good benefit. Now, the downside to it is, of course, like any other kind of plan, you can't be discriminatory. You got to offer it to the rest of the employees pretty much. And you got to make contributions on behalf of the rest of the employees.
So I'm doing that, of course. And I think it's really, for me in my particular situation, it's the way I think and the way I operate. It was very much in line with what I did. It was a way that I could give all my people basically a match, a considerable match on their 401k or basically an IRA for them personally. And then, of course, I get the benefit of having a very high amount of revenue that can be pushed into retirement. And now the trick really gets to be, how do you take that revenue and get it put into trust and things like that, so that they don't get it on the backside. But I think it's a really, 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 it's kind of technical, and it took me I bet it took me 6 months to actually get it fully comprehended, and I'm not even there yet, but I see the benefits, and that's something that it needs to have a sexier name is all I got to say. Cash balance plan. Okay. That's just not very, I don't think that's whoever came up with that from a marketing perspective dropped the ball.
Well, they certainly probably didn't work for the IRS, because everything that, or at least the people that advise Congress, because it seemed like every time you have a tax law passed, there's a cute little acronym that, like the CARES Act or the Secure Act, or, it's like that's the acronym for the title of the law.
Yeah.
And in this case, like you said, there's not a really good definition in the name itself.
Yeah, for sure. That's something that I could definitely talk to anybody who's on the call about and under your circle. I know a framework enough to get you started at least, but then you got to go I got some guys you can talk to. We gotta pick it up just a little bit, because I want to be very respectful of time, but let's hit these last few. We got 4 more to talk about. Let's hit them pretty quick. Rapid fire. Okay.
Bonus depreciation. Not too much to say about it. It's pretty straightforward. However, I'm not a big advocate of spending money at the end of the year just to save taxes. You got to make some kind of economic sense of why you're buying a piece of equipment and how much money you're going to make on the purchase of the equipment. I mean, don't just do it to save money on taxes. That should be your less of a reason for making that investment in that piece of property.
Yeah. People who aren't in business say, well, can't you write it off on your taxes? I'm like, yeah, but I'm basically writing off whatever percentage my tax rate is. They don't quite get that. They think that it's like found money or something.
Right. And, and in some cases, you may not get a direct benefit of it. If you've got an entity in which you have to have what's called basis in it, and your basis is not sufficient to absorb the losses generated by writing off that piece of equipment, you wouldn't get an immediate write-off anyway. You got to carry it forward until you reestablish basis in that entity.
It reiterates the point of why you want to meet quarterly, so you don't have to make that decision in December.
Right. And I will say this, that it's going to be phased out 20% a year for the next several years until the year 2027, and it'll go back to zero unless Congress changes the law. So
wow.
You get 100% this year in bonus depreciation, you get 80% next year, and it keeps dropping to the year 2027. So it's going to be a less of a benefit for the next several years, certainly.
Right.
And there's some limitations as to acquisitions between related parties, and you can have new or used property now, but you just can't have used the property previously, as what you're going to acquire. You couldn't have used it in a previous business or something like that.
Gotcha. All right, let's talk about deferred taxable income to future years.
If you look at this in conventional wisdom says always pay your taxes later than earlier, but sometimes it's not always the right thing to do. You got to look at the transactions and what you're trying to defer. Particularly small businesses with this current qualified business income deduction. If you reduce your income, you're reducing your deduction. So are you really getting any great benefit out of it by deferring it to next year? And you might be deferring it into next year when you're in a higher tax bracket. So
yes,
you ultimately pay in more tax because you waited until next year to pay taxes on the income. Now, going back to the accounting methods, this deferment of income, as I stated before, works really well for the cash basis of accounting. How do you do it? You just stop invoicing your customers at the end of the year, and you wait to December 31st or January 1st and send the invoices out, which means you're not going to get the cash money until sometime next year. You probably don't want to do that for some customer that's really slow to pay their bills anyway, because you're just delaying getting the money back.
Any penalty for that?
No, not really. I mean, you're allowed to do that. I mean, you're allowed to, run your business and stop
bill out whenever you want to. Yeah, we do that every year, and we do that every year. We put things into the next year, and maybe like what you're saying, it may not even be the smartest thing to do, but I do that all the time. Some we did forever. I mean, just like almost like we have a little internal meeting, and we may, instead of it, December about 25th, we stop, and then we start back on January 1, basically.
Well, I will say this, though, it doesn't work very well for accrual basis, because, if you're on accrual basis, you're recognizing income as you earn it, and if you've earned the right to receive the income in 2022, then basically under accrual basis, it's your income, whether or not you build it or not,
We may have a future question on that later, but talking about prepaying expenses to get higher deductions, what you got there?
Prepaying your expenses, the IRS has even put something into the regulations that allow this to be done. Basically, you can prepay up to 12 months of qualified expenses, meaning, take rent, for instance. You may pay all of next year's rent under the cash basis and deduct it this year. You got to be careful of a couple of things on that. You certainly want to tell your landlord that here's what I'm doing. So if you send them a check and they get it the first part of January, they may think you made a mistake and send the check back to you. So you want to kind of be careful, because if they send it back to you, that kind of blows up the transaction. You don't get the benefit. So keep your landlord in the loop if you're going to do this.
But if you had a stellar year and you think you're going to have a down year the next year, this would make a lot of sense.
Right. It may make a lot of sense to go ahead and take the deduction up front this year, for all of next year's rent. Now, very important, you can't defer more than 12 months. So you can't just take 24 months of rent in advance. It can be a maximum of 12 months. And you do want to have some things in place to make sure that you're going to get it. Number one, primary, is proof that you actually paid it. So, when you send it, certified mail, or priority mail, something that gives you proof that you actually mailed it in this year, but and so you get the deduction.
This would be one that probably would be very interesting. Hit me a couple of those just off the top so we can go ahead and I got to get us out of here. But what are some things you can give your workforce that are tax exempt?
Two primary things you might want to look at, and not too many people I don't think are using them. One is qualified dependent care assistance, where you can give up to $5,000 a year tax free. I mean, look at your workforce. I mean, if your workforce has small children and everything, they're going to need some dependent care to be able to work and everything. So that's a means of providing a benefit that's worth something to them, to offset the rising cost in daycare.
Yep.
That's one benefit. The other one is a benefit where you are allowed to reimburse for the student loan, the principal and interest. We've already heard that the federal government intends to forgive student loans, but with like anything else, it's already being challenged in court. So whether that sticks or not, it remains to be seen.
So you could pay your employees interest on their student loans and it'd be tax free?
Well, no, you can reimburse them up to $5,250 a year for their student loan principal and interest that they're paying. They actually have to pay it, but you could reimburse them.
And it's tax free for everybody.
Tax free. Now, with all fringe benefits, pretty much you got to offer it to everybody. All your employees, not just a select few. It has to be offered to everybody.
But if they don't have a student loan, then
they wouldn't. They wouldn't participate in it.
For sure. What about Venmo? We're seeing a lot of that going on.
This is new. This year. IRS came in and said, starting in 2022, that Venmo and PayPal and these other third-party processors are going to have to issue 1099-K forms for all payments of $600 or more. That used to be $20,000, and now it's down to $600. They're really trying to track the activity, and they're making sure that some of this activity is not escaping taxation. So they're putting the responsibility on the third-party provider to report the activity to the IRS, and they dropped the threshold down to $600. The problem with it is, some people use that for business and personal, so you got to be real careful. That you're not going to be taxed on a non-taxable transaction.
Yeah. Okay. And I'll jump in here just talking about technology and Section 179. It's probably really about too late for this year, maybe not, but technology is one of the things that you could put in, and there's other things, a lot of other categories under the Section 179 where you could write off, you could buy something. And this is what I've heard, like you could even lease something and get the write-off in this calendar year if it's a certain type of lease. Are you familiar with that, Michael?
Not directly familiar with the lease. It pretty much, I think a Section 179 deduction, you would have to own. I'd have to look at that and see, if there's been recent provisions in changes in the law that would allow you to lease something.
There was a particular leasing company they've been doing that, so I hope it's legal. But well,
I'm sure they've done the research to make sure that
they have. It's a big boy too, yeah. But there's some things that you can do that if you needed some technology and other things in your business where you could actually get the full deduction and either just take it this year or even if you want that lease route. And I'm not a huge proponent of leasing, I'll be honest with you, but again, whenever you're looking at it on the big macro level and you got a guy who you can, who knows how to crunch numbers, you can put those scenarios in front of them and you can determine some pretty smart things about how to, again, if you're just keeping a few points here and a few points there, you do that for 20 years, man, that makes up for you'll be in a different spot.
That's true. And you make sure you address the ramifications of the transaction before you actually do it.
Yeah. So I'm going to we have an offer for business owners that have come and joined this. We're calling it a free second opinion campaign. It's more like a business risk assessment, and it includes really some of the things that we see are the highest risk points for businesses. We'll do a email security review. We'll look at really the way you're authenticating, which is basically your username and passwords across within your business. How are you managing that authentication? That's another huge risk point for businesses. Microsoft 365, a lot of people are, they think of it just as email, but really, it's got so many more components to it with Teams. And, one thing Microsoft tells you is they don't back up their platform. Most people think, oh, I got it in my OneDrive, it's backed up. Looking at some governance documents, that's basically documents your hire fire policy, the things that you really should have within your, like your workbook for your employees. There's probably about 8 documents that you need to make sure that your employees have signed off on. Doing a cyber liability insurance review. I am still amazed at how many companies do not have cyber liability insurance, and just the amount of risk that they're taking for a relatively low cost. It's just something that I've been really, trying to push people towards to look at. And then looking at things from a disaster recovery plan. They say if you write on a napkin what you're going to do in the event of a napkin, you'll recover from a, like if you went to lunch with your key people and wrote down how you're going to manage a disaster, you'd recover 65% faster. So a little bit of work goes a long ways, and I'll help you with all those things. All you need to do is, that's your stuff. If you'll email security at AskBIS, I'll follow back up with you guys and do that. Here is Michael's information. He's with Byers CPA and Daphne. And, Michael, we're not going to have time for questions today, Christy, but I just want to say, thank you, Michael. Great information. I wrote down a couple things I certainly learned today, and I know everybody on the call is going to pick up something. And if you want to have more information about something from me or from Michael, there's Michael at Byers CPA. Follow up. Any last words, Michael?
I just wanted to wish everyone the happiest of holidays, and a couple of things, always be organized in your records and everything, and always file your taxes even if you can't pay them, because you can't be faulted for not paying your taxes necessarily. You will eventually have to pay them, but you can certainly have some issues if you don't file your tax returns. So always file them even if you can't pay them. And one final thought: just stay current on your payroll tax deposits, because the money you withhold from your employees, that's not your money to operate your business on. That's the government's money, and it's not your money. So that can cause
catch a charge on that one.
That can cause some major issues.
For sure.
So just be careful in those regards. And thank you again for having me. I appreciate the opportunity to discuss these issues and tax issues with you. And I encourage you and urge you to discuss them further with your professional advisors that knows your own particular tax situation. And
absolutely.
And like I say, this is general tax discussion.
And if anyone would like a recording of this, we'll share it in an email. You can just follow up and say, hey, I want a recording of this to share with your friends. Again, these are things that I want to, facilitate to get our business community, thinking, being savvy, and so we can, stay around for a long time. So thanks again. Merry Christmas, everybody. We'll talk to you soon.
Merry Christmas.